So with the bond market, I mentioned, I think that, and this was partly a shift and a pivot in the way I was thinking about things earlier in the year, which is originally I had thought that even if, say, bond yields go up, there's just going to be such a shift to short-term issuance. They're going to essentially almost stop, issuing net new issuance of coupon of 10 years, 30 years. But I think that the administration really has their heart set on a lower rates on the longer end, and basically kind of a flatter curve, a lower curve. And the way that I think happens is that you start to convince market participants that central banks around the world are going to keep the short end lower for longer, that they're going to be willing to look through 3.3, 3.4% inflation prints and say, we're still not going to raise rates. We're not even going to talk about raise rates. In fact, we might be lowering rates. And what that's going to do is ultimately, the pricing of the longer end is a string of shorter end yields. And so once participants begin to believe this, and then I think there is going to be this continued, dearth of issuance on the long end where, yeah, there's going to be some 10s and 30s and 20s getting issued, but it's not going to be, what it was pre-pandemic, and it's going to be a lot of bill issuance, and it's going to be a lot of treasury buybacks getting more involved. And I think when you put that whole mix together, what's going to contain that long end is that there's just a large amount of people who have to buy it, like very large insurance firms, pension plans that want to match up liabilities. And so you have almost like a built-in demand for a certain amount. And if you keep that amount relatively, low, and then you convince market participants that on the short end, you're not going to get a better yield because we're not going to be raising rates, then people will say, well, I have these liabilities. I need to get, a 4% on a fixed income. I'll buy the 30-year at 4%, or I'll buy the 10-year at 3.7%, or whatever it might get to next year. And so I think there's going to be that demand. There's going to be low supply, and there's going to be forward guidance from central banks that rates are going to be lower for longer. And that's essentially going to keep a lid on those things.